Shanghai flips the lights back on tonight, and a cash buyer in China just posted a price that makes Western silver look mispriced. And if that spread holds into the open, the next hour could rewrite the week. Welcome back to Vantage Economics. Let's start with what the tape already showed. Silver jumped at the reopen, pushed through a nearby ceiling, then smacked directly into the same supply pocket we outlined yesterday and snapped back. Not drawn after, not explained later. The zone was marked in advance, and the reaction was clean. If you're skeptical, pull up the prior upload and check the timing yourself. Because learning structure beats chasing headlines. Gold mirrored the rhythm. Early strength that matched the signal we had before most people finished their first coffee. That ES, the point of following the live flow. By the time a video renders and uploads, the first move is often done. If you caught the early read, drop a quick comment, because paying attention is a skill you build. Right now, gold is hovering around the low 5,000s as I record, and silver is sitting mid-80s in Western pricing. The next step is simple to say, but hard to execute. For silver to drive toward the low 90s, it must punch through the upper 80s band with speed. Not a slow grind, not a lazy drift. When price lingers inside a resistance shelf, momentum bleeds out and the people leaning short get time to rebuild positions. What we need is a shove. Fast acceptance above that area, or it's a stall. But tonight isn't a normal session, and here's why. Shanghai reopens, and the market it returns to is not the one it left before the holiday break. Western prices climbed while China was offline, which creates one unavoidable question. Where does the physical market in China actually clear when it S back? Now here's the detail that should make you sit up. A major silver recycler and scrap buyer in China, big enough that their bids matter, was reportedly offering to pay roughly $95 to $96 an ounce for 99.99 fine silver during the closure. That's not a social media whisper. That's a business price, real money, for real metal, nearly $10 above Western spot. Ask yourself, why would a large buyer post that kind of premium if supply was comfortable? Because premiums don't show belief, they show need. If that cash bid reflects where Chinese physical demand is clearing, tonight, ES reopened could force the story out into the open, after the fact, when the mainstream outlets try to stitch together a narrative. But you don't need a studio panel to connect dots you can verify. Watch the open. Compare the onshore print to Western paper. The spread is the message. And the bigger picture underneath silver right now is unusual. We're not just talking charts, we're talking positioning and pressure. One signal, options pricing. The implied volatility gauge on silver, what traders are paying for protection over the next month, has surged. Think of it as the market whispering, something is unstable. High volatility doesn't promise direction, it promises magnitude. It means participants are preparing for violent swings. So what's stressing the system? One major suspect is short exposure that IS functionally uncovered. Positions that become a problem when too many people want delivery or when price accelerates and margin requirements bite. Charts don't heal that kind of imbalance. Only forced exits do. And there are rumors, and some supporting indicators, that pressure exists not just in the West, but onshore too, where capital rules and hedging constraints can make it harder to offset risk quickly. When both sides of a market are tight, the spring compresses. Kindleberger wrote about how distortions can sit quietly and release all at once when the escape path appears. Timing is the trick. The build can look boring until it isn't. And lately, the how of suppression may have shifted. In prior cycles, you'd see obvious smashdown moves that looked like a hammer on the chart. Recently, those blunt hits appear less frequent. Instead, some traders are watching the options complex for activity that can steer price behavior more subtly. Harder to spot, harder to prove, but potentially effective. If you want to do the homework, pull the exchange data and watch how volatility and open interest behave around key strikes. Don't take my word for it. Now, zoom out to supply risk, Mexico. We covered the outlines earlier, but the situation has developed. A major cartel leader was killed in a military operation in late February. The immediate response? Disruptions, security escalations, transport interruptions, and a visible national mobilization, reportedly with intelligence coordination. That sounds like control. But history says leadership decapitations often trigger fragmentation. And fragmentation is messy. What does that have to do with silver? Mexico is the top silver-producing country on Earth. Roughly a quarter of global mine supply comes from there. Mining needs predictability, safe transit, stable operations, manageable extortion risk, dependable staffing. When regions destabilize, costs rise, timelines slip, and investors hesitate, and in a market already tight, even small disruptions matter. To be clear, we do not yet have confirmed mine output data showing an actual drop. This is a risk monitor, not a victory lap. But it's not nothing, and it's not resolved because one headline passed. Layer on geopolitics. U.S. assets are positioned in the Middle East at levels people compare to earlier crisis eras. The Iran file isn't done, it's paused. And pauses with hardware in place can end abruptly. When that kind of uncertainty hangs over markets, it embeds a premium in safe haven assets that doesn't vanish until the risk actually leaves. Right now it hasn't. You can see capital choices in real time. Precious metals moving higher while equity futures lean lower. Hard assets bid, paper assets shaky. That divergence usually reflects a collective decision about where safety lives. When fear rises, truth shows up in pricing. Here's the responsible caution, because this channel is not here to pump you into anything. A volatility surge cuts both ways. It can mean a short squeeze that rips silver upward. Yes. It can also mean a sudden liquidation event that drags everything down temporarily, including silver, if margin calls spread across markets. A coordinated defense by large players can also create sharp countermoves. If you trade, you already know this. Big opportunity and big risk live next door. So what happens tonight when Shanghai opens? Two paths. Path 1, onshore pricing reopens with a meaningful premium, validating that recycler bid as a window into true physical demand. If that happens, Western resistance becomes a speed bump, not a wall, provided price pushes through quickly. Path 2, Shanghai opens more cautiously, institutions reassess, and the premium compresses for now because the market moved while they were away, and they want confirmation. Either way, we get information we don't usually get. Mark Douglas taught probabilistic thinking. You can have a strong thesis and still respect uncertainty and timing. The core setup for silver, tightness, positioning stress, rising volatility, geopolitical premium, and potential supply fragility, may be as compelling as it's been in a long time. But anyone claiming they know the exact day and hour is selling certainty, not analysis. Certainty is expensive. Markets charge it with pain. Still, notice the asymmetry. What was true a day ago looks even more intense now. A real-world cash bid in China implies physical demand isn't satisfied at Western paper levels. The options market is pricing turbulence. The structural short exposure hasn't magically disappeared. And gold holding strong while risk assets wobble suggests institutions are rotating, not relaxing. So here's the practical playbook for the viewer who wants reality, not noise. First, watch Shanghai's reopen print and compare it to Western spot. Second, track the upper 80s zone in silver. Does price blast through or does it loiter and fade? Third, keep an eye on volatility. Does it keep climbing or start to cool? Those 3 inputs will tell you more than 10 opinion panels. If the onshore premium shows up clearly, that upper 80s shelf may be the last meaningful obstacle before the next leg. But it has to be taken decisively. Slow motion inside resistance invites sellers to reload. Force breaks change the game. Do the work. Check exchange data, follow the physical premiums, and don't outsource your thinking. That's how you stop being surprised. If this breakdown helped, hit like and subscribe for more on Vantage Economics. We'll keep it grounded, verifiable, and focused on structure, not hype. And tomorrow, we'll see whether Shanghai confirmed the signal or challenged it.